Okay, so we are now recording, and we'll give those who are logging on a chance to log on for just a couple minutes here. And I see the numbers ticking up. And we'll give it another minute or two, and then we'll go ahead and get started. Right. And the nice thing is, with our long-term credit union relationship through Northrop Grumman, we have clients logging on from all across the United States.
I love it.
Our long-term clients who have moved to better climates or better tax states or grandchildren or for whatever reason. So it's nice to see those that are all across the country.
Yeah. Now, is the Northrop Grumman Credit Union still on its own, or have they merged with other credit unions?
Still on their own. All right, so Quincy, I'm going to go ahead and introduce you, and we'll get started because I want to be sensitive for everybody's time. Yep. And we are absolutely delighted to have Dr. Quincy Krosby join us again to give us a market update, her thoughts on all things market-wise, digging in on some topics that we're hearing from clients that are around the inflation and Fed. So in just a minute, I'm going to turn that over. But if I may, I'm going to just give you some background about Quincy. Before we logged on, we were talking about our, we'll call it 2+ decade friendship. So I'm delighted that we've continued to stay in touch, and that Quincy has been with LPL now for a couple of years. So she is LPL's financial chief global strategist, and she provides a perspective on the global capital markets with an emphasis on the macroeconomic environment, coupled with the fundamentals underpinning the broader market landscape. She is a member of the firm's Strategic and Tactical Asset Allocation Committee, referred to as STAC by LPL. Prior to joining, she was the chief market strategist at Prudential Financial and global investment strategist at Deutsche Bank Asset Management. She also held global capital markets position at Credit Suisse and Barings. And before Wall Street, Quincy was a U.S. diplomat serving in Washington and United States embassies abroad. So we're talking about a very wide spectrum of experience that Quincy is bringing to the table. And again, we couldn't be more delighted to have you today. So with that, Quincy, I am going to just turn it over to you. I had sent you a couple topics that Liz and I have been hearing from clients where their concerns and questions are. And I think we all know it's just every month, it has been every month for a year, that we've been talking about the Fed and what the Fed's going to do and the rates and inflation. So maybe that's, if that works for you, maybe that's a good jumping off point.
Yeah, no, it's important. And I sometimes wonder if at the Fed, they're fed up, because this is the ongoing saga that we have had to deal with, that the market has had to absorb, and that all of us as consumers have had to absorb as well. Here's the irony. This is a major irony. And that is that the housing market, despite mortgage rates jumping up to 6%, the housing market is leading. New home sales are up. They are more expensive, but they are up. It's as if folks said, okay, let's just go, because existing homeowners are not putting their houses on the market, because if you've got a 2% mortgage or even 3%, you don't want to sell and then have to go and buy something with a larger mortgage and a higher price in many cases. So when we look at what the Fed is doing, it is, and I just want to point this out because I think this is important. It isn't just the Federal Reserve. It is central banks around the world. Over the last 3 weeks, we have had a downpour of global rate hikes from central banks around the world, all with this same explanation. And that is to restore price stability. Price stability means, for most central banks, an inflation rate of about 2%. And so this is where it gets interesting, because inflation has been coming down, and been coming down globally, by the way, but it is that last 2.5% to 3% that is what we call sticky. And it is the part of the cycle of raising rates where central banks have to make a determination. And this is what it is. The Federal Reserve has raised rates over 10 times. And we have 5% of, how do I say this, higher rates working their way into the economy. Most of us tend to look at the housing market because mortgage rates respond very quickly, because it's a different part of the treasury market that affects mortgage rates. So they respond very, very quickly. But for the rest of the economy, it takes about 10 to 13 or 14 months before those rate hikes work their way into the economy. And that is the case all over the world. I want everyone to keep in mind that when the Fed begins to lower rates, which they will when they feel that it's time to do it, or if some shock hits the economy, which we don't expect at this point, they start lowering rates. It similarly takes a very long time to work its way into the economy. And yet for mortgage rates, it will work very quickly. Now, all of that said, this economy, our economy, has been unbelievably resilient. It's mind-boggling, because normally when the Federal Reserve starts to raise rates, you start to see layoffs coming at a very fast clip. And recession works its way, typically, absent a shock like the pandemic, but works its way from the labor market. So if companies start letting people go, then the unemployment rate comes down, right? Or goes up, rather, forgive me. And then consumer spending is halted. And that's what's key here. Consumer spending is 68% of our economy. And the US consumer remains resilient, although we're more deliberate now, but we remain resilient. And so this idea of a recession hitting right away has been pushed out and pushed out. Even Chairman Powell made the comment. He was on Capitol Hill last week, testifying before the Senate and the House of Representatives, the banking committees, and the Financial Services Committee, and said the labor market is overachieving. And why did he say that? Because the Federal Reserve has two mandates. One mandate is price stability, keeping inflation at a level where we don't talk about it incessantly. And we don't go into a store thinking, oh my goodness, I better buy it today because tomorrow it'll be more expensive. But it also has a second mandate, and that's to provide an environment of sustainable economic growth. That is the jobs mandate. So that in many ways, the Fed has the luxury, I know that sounds odd, of raising rates again, and we think they're going to do it on July 26th, and maybe even after that, maybe in September. But at least July 26th, most of the futures market is expecting that. And why? Because Chairman Powell said it. He made it clear over and over again, short of sending us a balloon that says we're raising rates. Do you not understand? That's what we're doing. So right now, most of the market expects another 0.25% of a rate hike, but they're getting close to finishing. I don't think there's anyone who thinks that the Fed is going to keep going and going even through 2024. They will finish up.
Yeah. And do you think that's why the market has, back to the resiliency of our economy, but also just even this past weekend, my dad said, well, why is the market going up still? And so again, if you would comment on that, how is it that the market's going up? Is it looking beyond these next 2 quarter points?
That is really the market's job. When I started on Wall Street, I began, with the global trading operation, and then until I started to trade myself. But we always would say, the market gets the news first. It's an expression that has endured for so many decades because it looks way ahead. And by the way, Margie, you know this, the economy is not the stock market. Right. Sometimes it overlaps. And I know many folks, I have to explain it to my own family. It's not the same because again, this market's job is to take in and digest like a GPS, all of the headwinds and all of the tailwinds and look ahead and not look behind, but what's happening ahead. So a baby bull market was born technically. And what does that mean? 20% off of the low. It is a process. And there are always who are saying, not so fast, not so fast. But it is what goes into the history books. 20% down, 20% up, bear market, bull market. But here's the interesting thing about it. We always check to see which of the sectors made new highs as that 20% off of the October lows hit. And it was two. One was the semiconductors, which are the silicon chips. We want to see them making a new high. And the home builders. Sound interesting? The home builders made it.
Sure.
There was one sector missing, and that was the transports. Everyone, I think, on this call, I think, is at the point they remember the Dow transports. You want them participating in a rally. Now, what's interesting, though, is many have said, hey, wait a minute. In this day and age, the semiconductors are the new transports in that the market pays so much attention to them. And why? Because the silicon chips are in everything. For Christmas, I got actually a toothbrush that talks to me. That comes from I don't like it. I had to throw it out. But it had a silicon chip in it. You can't make this up. Your refrigerator, you know it, missile systems. It goes to artificial intelligence, everything. And so they are seen as the consummate bellwether for global demand. Still, I'm old-fashioned. I will be happy when I could check off the transports. And good news is actually many analysts are suggesting that the rails are going to have a comeback. I wait and see, but that would help me to see that. But in any event, a bull is a bull, a bear is a bear until otherwise determined with other data. And a bull can be a baby bull and never make it up. But this market is also, how do I say this, focused on those big tech names.
Oh, yeah.
And we can't deny that. And the fact is that investors and traders alike see those big tech names in many different perspectives. But one is, if I'm worried about a recession, I want to be in companies that have very strong balance sheets, rock solid balance sheets, and companies that actually have a global footprint and actually have good earnings expectations. They go to the big tech names because they haven't disappointed. There have been a quarter where they disappointed, but they go in there. And now you have the added attraction of artificial intelligence, which finally has NVIDIA up there. We're not saying go in there because we have another view of where we should be investing now. But empirically, that has been what's lifting this market higher to new highs.
And the frothiness, and now we're kind of experiencing that the markets have gotten a bit ahead of themselves.
Yes.
And it's not necessarily that we're now in this downturn that will continue, but I call it the trimming of the trees, the pruning. And
yes.
It's not going to grow to the sky any more than the market's going to continue to go up. And as you're talking about the big names in the tech, it's always interesting to me, and why, again, we have diversification, because as soon as you make that bet on one particular area of the market will make a fool out of you and me and switch gears. And we saw that last year with the big dividend paying companies. And now the switch back to what we call large growth in the tech side. So
exactly,
it is history repeating itself.
Yes, exactly. In fact, at LPL Research, we have been talking about the industrials. They have been doing incredibly well. And by the way, It's a large sector market, as you know, it encompasses so much. But machinery, anything associated with infrastructure spending and defense spending has been underpinning the industrials. And we look for pullbacks, and yet it is the little engine that could. And one added attraction is that we know statistically, and that can change, that if we do go into a recession, even a mild one, or perhaps a little bit deeper than a mild one, industrials tend to pull us out as the Fed lowers interest rates. So we've been looking there, and of course, bonds are back, and we have been emphatic about our view about the Treasury bonds, about investment grade, high quality investment grade, and also mortgage-backed securities. And we've had now a nice balanced portfolio, whereas before it was equities. That was the only thing that you could do. Now bonds are back, and they complement an equity positioning.
Exactly. And, we've been in this business long enough to remember 1994. That stands out in my mind. And we called that an aggressive Fed back then. And we saw bonds actually go negative. And this has been ongoing conversation with clients. 2022 was difficult because not only did equities fall, the fixed income side fell. And then 2022, with regards to the fixed income market being down double digits, that's unheard of. So yes, I'm with LPL and research that fixed income is attractive. We're getting yields we haven't seen in a very long time.
Exactly. And the thing I want to point out is the Fed was late, as everyone knows, to raising rates. They called it temporary. It was temporary. It was transient. But it wasn't. Then, and at the same time, the government had pushed so much money into our accounts. We called them transfer funds, that by the time we left the pandemic, we had inflation, supply chain challenges, and inflation that just was sticking and not temporary. At the same time, the Fed finally said, whoa, it's time to raise rates. They went cold turkey on us.
Right.
And then at a faster and faster pace. And that was like 1994. But it was boom. We went from one environment to the next one in just a matter of some months. And that was hard on the fixed income market.
Well, and the supply chain part of it too. You've got the stimulus, you've got inflation heating up, and then let's throw the third in there with regards to the supply chain. Russia, Ukraine, unfortunately, as we know, continues to be just such a dire situation. But if you would comment, Quincy, just geopolitically, whether it's China, Taiwan, most recently events in Russia, that would be awesome.
Well, you could see, though, and this is the fascinating part of how the market works. The market moves on. You'd have to argue that in Ukraine, Russia, it's gotten even more dire, if it's even possible. The market has moved on. And the market, again, is looking ahead. It doesn't mean that the market doesn't want to see the conclusion, to see a negotiated settlement, which perhaps, maybe, given Putin's perceived weaker position right now. I do want to add about that event over the weekend. There are conspiracy theories surrounding all of this, but one of them is fascinating, that it was staged, and that it was staged so that the Wagner Group, which is the mercenaries, these are the ones that, by the way, work in the Middle East. They've been active there for decades, and also in Africa, but that by staging this whole event, you get them placed in Belarus. And if you look at the map, take a look where Belarus is. It's right next to Ukraine. But that you've banished them. So according to this theory, the staging of the event has Putin banishing them to Belarus. And right now in Belarus, they're building camps for, and housing for the mercenaries. I don't buy that necessarily. I don't, but nonetheless, it's odd. And nonetheless, the market took it in and the market said, okay, perhaps it's over now. But nonetheless, the view is staged or not staged, conspiracy theory or not conspiracy theory, that Putin's position is weakened. The question now for the markets is, what does he do next? What does he do next to assert his dominance on the world stage again? Right? That's the question. Does he do something crazy?
Great question, right? Yeah.
China. You want to move over to China because this is a really important one for global markets. Global markets, especially in Europe, for example, Germany, France, believe it or not, the luxury goods sector are very much linked with Chinese consumer spending, but also industrial production. When it was announced that the COVID restrictions would come down and be finished, you saw a bounce in the Eurozone because they have strong ties with China, trading ties. However, the Chinese authorities just basically stayed with monetary policy, meaning tax cuts, help for the property developers who are mired in debt. And property development, by the way, is a major component of the Chinese economy, but tremendous debt. Also, the municipalities in China are mired in debt. And so President Xi, his regime has been intent on not creating more debt. In fact, it's just the opposite, which the problem is for markets, actually ties his hands in terms of fiscal spending, which is the government side, right? When we talk about the White House budget, that's fiscal. And so the market is waiting for some kind of fiscal stimulus, infrastructure spending, whatever it is, to help the economy domestically in China, because the other problem they have is a 20% plus unemployment level, including high youth unemployment and new graduates from college unemployment. Wow. China does not allow marching, does not allow demonstrations. The demonstrators who ultimately made the government get rid of those COVID restrictions, no one has seen them. No one knows where they are. So they are compelled to come up with something that takes care of employment, because that number is too high, particularly for young people. You have seen commodity prices stay modest. Oil prices stay modest because the idea was China, the world's second largest economy, is also the largest importer of oil and also user of commodities. None of it's happened. The market is waiting. Taiwan is a different story. Janet Yellen is supposed to go over to China, discuss potential trade relations or whatever. At the same time, the Biden administration is upping the restrictions on trading with China. That's the only thing that the Republicans and Democrats seem to agree on, is having an embargo on many of the tech, especially tech products going to China. Taiwan is the other issue. It hovers over any bilateral discussions. Why? Because Beijing has made it absolutely clear over and over again that Taiwan belongs to China, that Taiwan is China, and it will be China, even if they have to use force. And to end this part of it, because I could go on and on, right. But they have resurrected the agreements that the Chinese authorities had with the Nixon administration, in which the Nixon administration agreed to one China. America, the United States, for many decades had a policy of strategic ambiguity. Well, we didn't really commit to defending Taiwan, but we would do this, but we wouldn't do that. That changed both on the Republican and Democrat side, where they came out over and over again, we are going to defend Taiwan. So it's created a dilemma in terms of commitment, but the Chinese authorities have not wavered in one bit. How do I say this? They have made it clear, we will do this the easy way, or we're going to do it the hard way, but it's going to be done. Either they get leadership in Taiwan that agrees with Beijing and that is pro-Beijing. And may I do one more Chinese thing?
Sure.
One more, because if anyone doubts it, just look at Hong Kong. Hong Kong was turned over to China, to Beijing, at the end of the 1990s. The stipulation was that for 50 years, Hong Kong would remain quasi-independent, right, as an administrative entity. And then after that 50 years, obviously completely linked to Beijing. It didn't take very long for mainland China to change that, because they did it. And even there, the leaders of the movements to maintain their independence for the time that they were supposedly allowed, no one knows where they are. I rest my case.
Yeah, it's, well, and back to just from the global economy standpoint, and China's economy is slowing. You know, I've heard more about India recently than I have for a while.
Yeah.
And we seem to be coming on strong. And again, just thinking back throughout decades, it used to be that we really didn't care a whole heck of a lot what was going on the other side of the world. And now it's just so intertwined. And our international space, back to portfolios and portfolio construction, aside from China, is more intriguing. And with where assets are priced on the international as opposed to the frothy US market, we have been looking at increasing our international positions. We have increased our international positions, not dramatically, but to some extent. So I think just from valuation standpoint, there's compelling reasons.
So have, we upped our position for developed markets. Take a look at Japan. Japan is off the charts, literally off the charts if you look at the charts. And why? Japan is the world's third largest economy. And yet there's always been a question about shareholder value. That's been the issue. And now they want global investors coming in. Warren Buffett has been active there for many years. He has re-engaged. He is wants more positioning in the trading companies he's involved with. But we are starting to see not just words, but a couple of companies beginning to accept the notion that you must deliver shareholder value to have investors, not traders, but investors. And this is changing, and slowly but surely. But I think it's very important because we now have a new developed market where many institutional money managers are saying, let me see, let me try it, trust but verify. Also, Mexico, nearshoring. Take a look at the Mexican economy. The peso has been crazy, moving higher, perhaps too much, but nonetheless, the nearshoring and friendshoring is another part of the deglobalization that we are seeing around the world.
Yeah, no, it's absolutely been fascinating to see how this is unwinding, and that's an interesting point. Again, I'll have to do a little deeper dive on the Mexico side of things. So that's important. So let's talk about our own political climate. It's always interesting, again, in client conversations. People are pretty opinionated, one side or the other. Liz and I, and when we're having our client discussions, our feedback is, look, we're politically agnostic when it comes to managing your assets. And we can't let politics, and whether it's our beliefs or client beliefs, dictate where those assets and how we're investing. At the end of the day, we're looking to protect and grow for our clients. and in some cases, depending on the environment, more protection. So here we are, a year plus from the next election, with, shall I say, a totally dysfunctional Washington, D.C. Any comments on this upcoming year as we get closer and closer to the next presidential election?
Yes, thank you
for
on
the spot there, right?
Well, I have to deal with my own family, friends. We agree to disagree, right? And we somehow we get through. I mean, that's the beauty of the system. Somehow we get through, and the debt negotiations showed that, did it not? I mean, we finally got through. That's the thing about democracy, and our enemies, which we have, were playing this up in their local press of how dysfunctional America is. Why would you want to be in the U.S. dollar? Because look at how they can't agree on anything. It's sort of like going into a kitchen of your favorite French restaurant, and you're like, oh my goodness, and yet at the table is set and it's beautiful, and the presentation is beautiful. That's democracy at work, and we did it. We got through it, and But all that said, let's just face it, that for markets prefer to have business-friendly regulations, business-friendly taxes, and that's important. And that will be important in the upcoming election as well. The thing is that the economy is crucial for both sides of the aisle, that companies in our country can deliver shareholder value. That's crucial. So we can't have a system in which corporate America is unduly punished, or small business owners, who are the backbone of our country in terms of job creation. They cannot be punished. We need to have entrepreneurs feel that they can continue to do what they're doing, and that they can create a company that then could be listed on the stock exchange at some point and raise capital. That environment makes us special. That in many ways, capital markets are the essence of American capitalism. And this is why I personally, having lived overseas, worked overseas, go to school overseas, I look around the world and I just come back here to the US, and sometimes I feel like I'm running for office myself, but we have the best system in spite of Washington. That's the point. In spite of Washington, that creates a landscape for companies to thrive, for mergers and acquisitions, which are healthy, and getting to the point of where we are right now, by the way, because I'm writing on this week, is we're beginning to see the beginning of capital markets come back to life that have been dormant during this period as the Fed has been raising rates, and the banking crisis and the fear that a recession is around the corner. We're finally starting to see the initial public offering market come back up. We call them green shoots for obvious reasons, but it's important. This is what makes it all happen. And this is why it is important of who's in the White House and who's in Congress. And I, for one, and you're going to catch me on this, I like divided government. I think it's healthier.
Like divided government. Day, right?
Absolutely, the markets like it, because what it does is it helps thwart anything that's kind of, that belongs to the extreme part of the two-party system. It tends to thwart any extremism coming into play. And that's why I think the markets find it very healthy.
So let's talk about energy for a bit. It's quasi still, I'll segue into energy from the political comments here. And, once again, we're seeing a change taking place, an evolution, if you will, whether it's the electric cars and all has transpired probably 10 years, but it seems more so over the last 5 years.
Yeah.
And just again, your background, I believe there's some background on the energy side. So if you could share with us just some thoughts on that.
Yes. It's funny, we're getting more and more questions about this, but the energy complex isn't just about crude oil. It's also natural gas, and natural gas prices have been coming up. So you can see a kind of a shift right now as well. Maybe it's perhaps positive to get back into energy because natural gas. Now, granted, crude oil has been under pressure. And this is important because the death of crude oil, the obituary for crude oil, has to be revised, every year, because we in the United States certainly not prepared for electric vehicles. You can't even get one. They cost an awful lot, but where am I going to charge it if I want to go cross country? And everyone knows this. We may get there. 5 years, 10 years, whatever. But you need to have a viable energy solution until you get there. In addition to that, around the world, crude oil is used for all kinds of daily living, and it's important. Every time the International Energy Agency, IEA, has come up with their peak oil year, invariably it's wrong. And we have to revise it. So the thing about the energy, and this is the crude oil here in the US and overseas as well, is that companies have been delivering shareholder value. You remember, and I remember when, oh my goodness, oil prices are up, let's spend a fortune, let's go digging, let's exploring. No, now it is very cautious. They don't believe that it's hospitable in DC, but they are delivering shareholder value. And another thing, and that is it doesn't take that much. It's $45 a barrel for Western companies to break even. So anything above that is obviously gravy, so to speak, dark oil gravy. But over in Saudi Arabia, it is not even $3 or $4, and that's factoring in everything.
Wow.
That's factoring in absolutely everything. So here's the interesting part of this. OPEC did incredibly well as Russia and the Ukraine conflict geared up. They made money hand over fist, and they need it. They have an enormous budget that has to be taken care of. They are building a world that is post crude oil. They're building cities. That costs a fortune, and they want to see oil prices higher and higher. That's their bank account. And they know at some point it will be over. They all do in the Middle East, but they are all planning for it. So seeing the Saudis on their own say, hey, now we're going to cut production again. Maybe the timing was a surprise, but they want to protect that price of oil. But again, above all else, it has been about shareholder value. They have been buying back their share price stock. They have been raising the dividend. They've been offering special dividends. So when you look at it, it is more than just the big integrated oil companies. There is going to be drilling. There is going to be exploration. And so you look at the service sector companies that work with all of the energy companies around the world. I'm not endorsing this. I'm just giving some names. Right. Halliburton, Schlumberger, just to give you an example, if you look it up and see what they do. And how about this? We have not built a refiner in this country in decades. So refiners actually do well. And I would also add that a lot of Americans are basically saying, okay, if I have to buy an electric vehicle, maybe at some point I will. But, in Europe, they have said at 2035, that's it. the unions that built the cars, you don't need as many workers to do an electric vehicle. So the unions years ago, once they came up with that 2035 date, said, okay, in that case, we want this, and we want that. We've heard in the US and California that after a certain date, you can't buy a combustible engine vehicle. So that leaves us with our Suburban, and we are, okay, maybe we should get another one just in case. But the point I want to make is it's coming. There's no doubt about it, but it is going to take a long time.
Well, and back to the infrastructure that needs to be in place to support it.
Exactly. That's why infrastructure spending, and when we talked about industrials, and the machinery, the components, you just across the board. Not to mention that industrial companies in the US are very active over in the Middle East, creating all kinds of systems for air conditioning and so on and so forth. But as I said, the death of crude oil is keeps being changed and revised higher. Now, getting back to the market right now, Russian oil is still finding its way. You could say all you want about the sanctions. Russian oil finds its way. And you mentioned India. One of the things that happened when the head of India was in Washington just recently, last week, I think it was, there were many comments. I hope the administration is asking them, why do they keep buying Russian oil? Why do they keep doing it? Turkey buying Russian oil, member of NATO, buying Russian oil. We actually saw a study that Russian oil was showing up in New Jersey and New York City because, yeah. So, and obviously for the price of oil, you want Russian oil out of the system, correct? If I'm just looking at price, I'm looking at, but what they're doing is they're selling oil to China, which is not a surprise. But nonetheless, crude oil is still an important part of the global economy. It will be for many years until the infrastructure is in place. And that in our country, that Americans embrace the vehicles. That they're too expensive for most Americans. So.
Yeah, well, and I come back to, if I'm going to go on a long drive, I think I'll stick to my gas-powered car for right now.
Exactly. Yeah. Yeah.
So just going back over recession buzz and, thinking back, yes, we had, of course, the 2020 COVID recession, shortest lived bear market and recession in history. Mm-hmm. And then prior to that was 08, 09. And that took a while to get back to those levels. Again, one of the common threads we're hearing from clients as they look at values of their portfolios and the end of 2021, that is our now high watermark. And this is across the board. In 2022, there were really not any places to hide except for cash. And now we are seeing cash, CDs, money market rates coming up quite nicely. And not, again, that doesn't have a place in portfolios. Cash is an asset class after all, but we got to be careful not to get too infatuated with rates as they are. So I kind of throwing a lot out there. Recession, are we going to, here's one of my old adages, Wall Street climbs a wall of worry. And that's what I've seen happening this year. We've got plenty of things we can worry about, but the market has marched on. And when that recession hits, and we know it will, it's not the end of the, again, investing. We make our way through it by having diversified portfolios, having places to go. We talked about fixed income coming up, yields are attractive, and there is just overall return potential there. So I think, if again, you can talk a little bit about not having a crystal ball, because we do not have one of those on any of our desks. Let's say recession hits. isn't that often like, yeah, we already know that. That's the Bureau of Labor Statistics finally confirming it, what has already taken place. And if unemployment remains as low as it is, maybe we're just not going to even go there. And we just continue to kind of grind through this period of higher rates. So I don't know if there was a question in there other than ask to comment.
No, but Chairman Powell, before he was chairman of the Federal Reserve, was the Federal Reserve governor. And when he would give speeches, he would always talk about the danger of very low rates, how it forced risk-taking, too much risk-taking to have returns, and that at some point it would lead to trouble in financial markets. And you may remember when he became Fed chair, on the attempt in 2018 to normalize interest rates. It was difficult, very difficult for the market. But when all is said and done, having rates at 4 or 5% is not abnormal. That's actually historically right there, that's normal. What we've gotten used to is real rates is sometimes negative if we factored in inflation, or 1%, 2%. That is an extreme. And so I think it's that, we'll get used to it if we settle at 3% or 4%. But overall, if we do have a recession, which, as you point out, it is normal. Recessions are normal. They're healthy, but it's not 2008 and it's not 2009. And that's important to remember. That led to a complete debacle in financial markets in 2008 and 2009. And that was different. So what the Fed is doing, it, again, as we said, has the luxury, quote unquote, of a resilient economy. Unemployment stands at 3.7%. Even if we went up to 4%, that is not, miserable. And most people are finding new jobs. That's the other part. We have so many job openings. The other aspect to it is, in terms of our view, is, yeah, we probably will come into a slowdown, a recession again, as all those rate hikes work their way into the economy, but we'll muddle through. That's very scientific, that we'll muddle through. And muddling through is not bad. I look around and where we live, people are out shopping, but they're going out to dinner, they're going to concerts, the airports are packed, and you look around. And by the way, if you go back and look at when folks were targeting a period of recession, it was right about now, wasn't it? That we would be in a recession now. I tell you that the estimates right now for the quarter that we're in, the period we're in, is just under 2%, and it may even be above, given today's data that was released.
Yeah, and you bring up a point. I certainly am that observer as well, of full parking lots and entertainment tickets, and on it goes. We, the consumers, and we represent, what did you say, 68%, I think, of our economy.
Yeah.
We're going strong. And so, I just want to reassure our investors, clients, on the call here today, on the Zoom here today, that there are always going to be different weather patterns. And from our seat, we have to be prepared for, I'll stick with weather, because here in Maryland, we're finally getting our humidity and storms and our normal type of summer. And yet hurricanes, I'll just draw some analogy here with weather and markets. Yeah, we've got to be prepared, but we're going to make our way through it. And then when we get a nice run, great, let's enjoy it. That might be, in our case, we're pulling some profits off the table and doing the rebalancing. And it's an ongoing process, but I can't stress enough, preparing in advance. And that's for either side of what the market does, because over the short term, nobody knows for sure. And call them black swan events. That's, I think, a good term.
Yeah.
They will continue to happen. And our position is to help our clients be good stewards of their money. And it's always insightful to have I could go on for another hour talking to
I love
Krosby here,
Yeah.
because I just really enjoy listening and learning always. So anything before we have to sign off, because I, again, need to be sensitive to our participants' time. Any last comments?
The last comment is, for everyone to have a safe and very, very thoughtful 4th of July. And to realize that betting against this country, betting against our stock markets has always been a losing proposition. I think Warren Buffett said it correctly. He made the comment at his last meeting, right, for the investors. He said, I couldn't have done all of this. We couldn't have built Berkshire Hathaway without the backdrop of the United States of America. The United States of America could go on and on without us, but we couldn't without the regulatory and how do I say this? The very ethos of our and essence of our country. He said that is what has allowed him and Berkshire Hathaway to prosper. And that's he's someone who calls it as it is. And he called it, and I think that's we need to echo that. And when we look around and understand what our country stands for, to rejoice on both sides of the aisle.
Yes, well said, Quincy. And you said it before, but you can look around the world, but I can't think of a better place. And aren't we fortunate to have landed here in the U.S.?
Yes.
So I'm going to just pull up our closing screen here, if you'll bear with me. And I want to just be sure I get this up here. So hopefully oops, go back to this. And I think that will be showing now. There we go. So again, I want to thank all the participants who have joined us today. I want to thank Northrop Grumman Federal Credit Union for our 23 plus year relationship. So it's been a privilege to serve our clients wherever they are in the country. And happy birthday, America. Quincy, a pleasure as always. Thank you so much for your time today. And for those on the line with us, if you have questions, you see Debbie's contact information here. Please feel free to send questions. And we have good communication with Quincy, so we can pose some questions to her if they were not touched on today. So I will hope to see you in San Diego at our big conference in a couple months. Great.
Thank you. And thanks for inviting us, LPL Research. Thank you all on the call. Take good care. March, thanks so much.
Great to see you. Thank you.
Bye. Bye.
Bye-bye.
Bye-bye.